Mutual funds often distribute capital gains at year end, often much to the surprise of their shareholders. And last year, Vanguard distributed a fairly large capital gains, which took many shareholders by surprise. And here to talk with me about that is Jae Oh, author of Maximize Your Medicare. Jae, welcome.
Thanks for having me, Bob.
So what do we need to know about this, in this case, the capital distribution from Vanguard to its shareholders, and what's happened in the wake of that distribution?
Sure, and let me first start by saying I'm not an attorney, right? So there are going to be a lot of technical details on the mutual fund accounting, the way the units are distributed and redivided, things that we won't resolve here. Nevertheless, at the end of 2021, a large long-term capital gains distribution did take place. And the main point here for me, and as mentioned in Maximize Your Medicare and in our other conversations together, is the fact that this changes your taxable income. And the ripple effects can be wide and significant. For example, under the Affordable Care Act, the advanced premium tax credit actually changes with every single dollar of extra income that you may earn. So you can understand the notable surprise that persons presumed taxable income of some level, and then all of a sudden in late December receive a big number which may have increased their taxable income, thereby reducing their advanced premium tax credit. The net effect would basically raise their health insurance premium under the Affordable Care Act. Under Medicare, slightly different, but still possible, which is that under Medicare, there's something called IRMAA, which is an adjusted Part B and Part D premium based on your income tax level from 2 years prior. And again, a distribution into a non-retirement fund, meaning not your IRA, not your 401k, but in a non-qualified source, would increase your taxable income and possibly expose you to IRMAA.
So for folks who own mutual funds, what advice do you have? Should they be keeping an eye on perhaps the unrealized capital gains distributions in their funds, or some other advice you might have?
Well, not specific advice about a particular security, Bob. I do think that what it does is it highlights the idea that asset location is an important topic. Certainly, you've got other contributors who are also mentioning this, and its importance. What is largely unknown is the fact that the ripple effects are not only on their taxable income, but then what I call a hidden tax. Not really hidden because it's known, but not many people are aware of it, meaning that the ripple effects extends to health insurance premium and possible your Medicare premium.
Right. Well, we covered a lot of ground. Anything we missed, or anything that bears re-emphasizing?
I do think that this is not going away, Bob, which is that as people work beyond 65 and more attention is paid to vehicles to try to reduce taxes under retirement, that unknowingly these kind of ripple effects can occur.
Right. And I suppose just my closing thought is the need perhaps to be cognizant of tax efficient investing is perhaps one thing that someone could do to protect themselves against unexpected capital gains distributions.
Absolutely.
Well, Jae, as always, want to thank you for sharing your knowledge and wisdom with our readers and viewers. It's greatly appreciated.
Thanks for having me, Bob.